commodities and gold and silver, hard assets, they're going to see a lot of money flow into them. And they're such small markets now that, in my opinion, explosive. I think one of the most important things about buying physical gold and silver is that you need to be patient. And you need to think like a central bank. You have to think of how many ounces you have of gold and silver. And like today, the day we're speaking, gold has gotten hammered. But I've looked at the year-to-date performances. Gold is up about 10%, and the NASDAQ is down about 1%. And silver's up about 9%. Yeah, I'm bullish on gold, silver, and hard assets.
After a record-breaking rally, gold prices have retraced this week, shedding 2% over the last 5 days. Despite this pullback, the broader bullish trend remains intact, with investors eyeing the $3,000 mark as the next key resistance level. While the recent dip might appear concerning, it could be a temporary correction before the metal resumes its upward trajectory. Gold prices fell below $2,900, currently hovering around the $2,890 mark on Thursday. The gold-dollar index has declined nearly 2% this week after reaching a high of $2,945 over the weekend. As markets opened on Thursday, gold saw further pressure, losing more than 25 points and dipping 0.87% on the charts. According to financial markets and macroeconomics analyst Mario Innecco, investing in physical gold and silver requires patience and a long-term perspective. Despite short-term fluctuations, gold has risen 10% year-to-date, while silver is up 9%, outperforming equities. This trend underscores a broader shift from financialized assets to tangible hard assets as investors seek stability in an uncertain economic landscape. According to the Bureau of Economic Analysis, the U.S. economy expanded at an annualized pace of 2.3% last quarter. This figure remains unchanged from the initial estimate and aligns with consensus forecasts. However, the latest data reflects a slowdown compared to the 3.1% annualized growth recorded in the third quarter. Innecco warns of dollar disease in the U.S. economy, where financial speculation overshadows real growth, benefiting Wall Street while industrial sectors struggle. This shift could lead capital to flow into commodities like gold and silver, enhancing their appeal as trusted stores of value. The recent dip in gold prices may be a temporary correction. With ongoing inflation concerns and economic uncertainties, investors will likely see gold and silver as safe havens. If bullish momentum continues, gold could surpass $3,000 in the coming months. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think one of the most important things about buying physical gold and silver is that you need to be patient. And you need to think like a central bank. You have to think of how many ounces you have of gold and silver. And like today, the day we're speaking, gold has gotten hammered. But I've looked at the year-to-date performances. Gold is up about 10%, and the NASDAQ is down about 1%, and silver is up about 9%. Yeah, I'm bullish on gold, silver, and hard assets. Mainly because I think the 40 years of everything bubble and financialization are over. And I think one of the big symptoms indicating that is what President Trump is doing in terms of tariffs and like trade and trying to bring back manufacturing to the U.S. I watched Luke Groman speak to Tucker Carlson, and he talked about the Dutch disease is when a country finds a commodity and focuses only on that commodity and neglects the whole economy. He gave a really good analogy of that, and he said that the U.S. has got the dollar disease. They've been borrowing and spending for 50 years, and the whole economy is like rotting away, the real economy. The only people who are doing well are Wall Street, private equity, hedge funds, because they play the paper game and they use leverage. I think this is almost over. Commodities and gold and silver, hard assets, they're going to see a lot of money flow into them. And they're such small markets now that it's going to be, in my opinion, explosive. I'm not telling people to do it. This is my opinion. I think, Daniela, fiat currencies don't last forever. and a higher price of gold is a reflection of that as well. I think that that has been happening already, um, as we see all the fiat currencies drop and gold go up quite a lot. I mean, since the beginning of this century, we're up about 9-10% in all the major currencies. That is a gradual reset, but we could have something more serious where countries like the US, China, and Russia get together, decide upon some kind of monetary agreement, because that's the only way to keep trade and investment between nations on a stable basis. The last 50 years of the dollar standard, or the fiat currency standard, is on its last legs. So yeah, it could happen. I mean, it could happen this year, could happen next year. I've done some research about like cycles, monetary cycles, and if you go back to 1933, that was the last time there was a major monetary event, when Roosevelt made gold illegal. Then he revalued gold in 1934. And if you add, let's say, 47 years to that, you get 1980. That's when the gold silver ratio went down to 1, and Volcker allowed rates to go up to 20%, and gold topped, and then interest rates started going down, and you add 47 to 1980, you get 2027. So I think we're due for some kind of event. And even Secretary of the Treasury Scott Bessent said in an interview before even the elections, he thinks we are nearing a Bretton Woods like realignment. So that can only mean
Yeah.
some kind of conference between these great powers. And hopefully Europe will be involved, because right now it seems like the U.S. Is aligning. It's more friendly with Russia than Europe. They voted together in the UN yesterday, um, vis-a-vis
Yeah.
the Ukraine situation.
Mario Innecco highlights an interesting trend. The U.S. is experiencing some delays in gold deliveries, now stretching between 4 to 8 weeks. This has raised a few eyebrows regarding supply. Although the Bank of England holds significant gold reserves, only a fraction has been moved recently, leading to longer than usual wait times. The Bank of England is navigating tough challenges in fulfilling requests for physical gold. What typically takes just 2 to 3 days is now taking weeks, which certainly raises questions about the true availability of its reserves. This situation is driven by a surge in demand for gold, compounded by large shipments to U.S. COMEX warehouses and some global political uncertainties. Some critics have raised concerns about potential fractional reserve practices, suggesting the bank might be lending gold it doesn't have in hand, causing a liquidity shortfall. The delays and somewhat vague explanations about logistics have sparked speculation that the bank may be trying to reacquire gold to meet its commitments. If these issues aren't addressed, it could shake confidence in the Bank of England's role as a reliable global custodian, potentially impacting the overall financial landscape. Let's get back to the interview.
I don't think it's the tariffs, even though it could have triggered some buying. I saw the report from the FT on January 29th, and I'll never forget that date, because I think it was the most important date for the gold market since Gordon Brown announced he was going to sell half the UK's gold. And why do I say that? Well, I was coming out of sports physio. I had a bad elbow, and I got a notification from the FT saying that there was a stockpiling of gold going to the US. And I read the article, and it said that the spot price was now T plus 4 to 8 weeks, which I thought was shocking, because the Bank of England is supposed to have 400,000 of those 400-ounce bars. And from what I've read, only about 2% of those bars have gone over to the US. So
Mm.
why do they have to like delay delivery? So, and now you're talking about Switzerland. Yes, there's gold going from everywhere to the US. And a lot of people are saying that it's to do with arbitrage, that they buy in London and sell on COMEX because of the
Yeah.
premium. but they used to use EFPs for that, exchange for physical, and that term exchange for physical is really misleading because I remember when I worked as a futures broker, I traded the government bonds, but some of my colleagues traded gold futures and silver futures. And I used to hear about EFPs, and I asked them, "So are you taking delivery?" And they said, "Oh no, this is just a paper transaction." Futures brokers hate taking delivery. I asked my boss once because we had a client who traded a lot of gold and silver if we could take delivery, and he said, "Forget it." So, to, some people speculate that there's 2,000 tons now gone to the U.S. over the last 2.5 months. I think personally, it's to do with the U.S. and the Treasury closing out its leases on the gold, or maybe there isn't much gold left in some of the depositories like Fort Knox. I don't think it's China because they've already been accumulating a lot of gold, and we also saw that earlier last year, before November, the Chinese were actually buying physical gold from London. We saw, I think it was Jan Neuenhaus from Monetary Metals. He did a lot of research about the customs data, and I think the Chinese buy a lot of gold from directly from mines these days as well, and they
Yes.
keep all their gold that they produce in China. Yeah, it's very strange because the COMEX market and the LBMA, they're, I don't know if you know the term bucket shop. That's, I learned about that reading about Jesse Livermore when he started trading as a teenager. He didn't have
Yeah.
enough money to trade in the with the stockbroker in the real stock market. So he just bet on prices in these bucket shops. It sounds weird, but I think the LBMA and the COMEX are 90% bucket shops. They're just trading the price of gold, betting on it. But when someone comes and asks for delivery, it creates a huge problem.
These ongoing delays in gold deliveries highlight a deeper issue within the global bullion market. As demand surges and logistical bottlenecks persist, concerns are growing over whether major financial institutions can meet their gold obligations. If these disruptions continue, they could undermine confidence in key custodians and reshape investor sentiment toward physical ownership. With economic uncertainty and shifting market dynamics at play, the question remains, could these delays signal a more considerable liquidity crunch in the gold market? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.